branch of ICI. Welcoming all of you for the Sunday morning's VCM on Investor Awareness Program. Today we have with us Mr. V. Nagappan. Morning and welcome, sir. Who is going to educate and create awareness on this specific topic to us. Sir is an experienced and practical oriented person who is dealing this topic as his daily activity and routine. We members generally busy with our day-to-day practice and employment and cannot concentrate on this particular core area. We from Hyderabad branch thought to conduct this one to enhance and enrich our knowledge, health with less tensions and wealth creation ideas, which we can undoubtedly convey to our clientele too. With this brief forward, it's my pleasure to introduce Sri Nagappan sir. Sir is a founding trustee of Foundation for Financial Freedom. He is a postgraduate in Business Administration MBA with gold medalist, President-elect Hindustan Chamber of Commerce, currently member Board of Studies. 1 minute, sir. Sorry. Currently member Board of Studies, Madras University for PG Commerce Department and Economics Department, Kalai Singham University and DG Vaishnav College. Sir is an Honorable Treasurer, Vijayodaya School Society. He is a founding member for the Ajjar Theosophical Academy. Served as an independent director on the board of Tamil Nadu Newsprints and Paper Limited TNPL, Tamil Nadu Power Finance and Infrastructure Development Corporation Limited and TIDCO, Tamil Nadu Industrial Development Corporation. Served as member of the high-level committee formed by Tamil Nadu government to revisit and frame policies and guidelines for disinvestment of shareholdings by SPSUs. Sir is past president of STOWA, Securities and Timeshare Owners Welfare Association India. Sir served as chairman, expert committee on economic affairs, insurance and banking, Hindustan Chamber of Commerce. Sir is an honorable secretary, Associate Chamber of Capital Markets. Mainly, sir is stockbroker since 1992 and served as director MSC Financial Services Limited, a subsidiary of Madras Stock Exchange Limited and SEBI registered member of BSE, NSE and MCX SX. Sir gave guest lectures and visiting faculty in universities and institutions like IIM Trichy, IIT Chennai and Capital Market Regulations and Finance. Sir is a resource person, National Institute of Securities Market, served as chairman of Economics of Board, MSc Institute of Capital Markets. He is a trustee for Tamil Nadu Foundation. He is a director for Madras Stock Exchange. He is a chairman for Federation of Indian Stock Exchange. He is a member of SMEC, Secondary Market Advisory Committee. Served as member for Disinvestment Committee, trustees of Settlement Guarantees Fund, and served as member of Defaults Committee. He represented MSc in FISC, served as honorary secretary to FISC. Sir is a chairman, expert committee on capital markets, insurance and investment for Hindustan Chamber of Commerce for 2010 to 14. He is a Rotarian and member of Hindustan Chamber of Commerce, Indo-American Chamber of Commerce, Andhra Chamber of Commerce, Madras Management Association, Tamil Nadu Investor Association, and various other trade bodies and social organizations like Blue Cross, INTOG, BNHS, etc. With this small brief introduction, we are lucky to have so much experienced person to address it. Sir, the screen is yours. You can take forward the session.
Yeah. Thank you, Mr. Satish Kumar, for such a nice introduction. And I would like to thank the SIRC of ICAI, Hyderabad chapter, for inviting me for this lecture. It's always a pleasure meeting up with chartered accountants and interacting with them. And this meeting also I think it will be more interactive than me talking alone, because you're all experts on the topic. So I will try to talk as little as possible, maybe about 45 minutes or about an hour or so. And then I don't mind taking up more questions, in the chat box after that from all of you. Anything related to stock markets, mutual funds, asset allocation or diversification, or little bit of tax planning, not that I know better than you, but from the stock market point of view, I can talk about that a little bit, and overall scenario, how the market trends are all. So let me also start by saying that my connect with Hyderabad, when you invited, my son studied in Nalsar National Law School there in Hyderabad, and when I was a chairman of the Federation of Indian Stock Exchanges, I have visited the Hyderabad Stock Exchange a couple of times those days. So with that fond memories, I start my PowerPoint presentation. And okay, is the screen visible, sir?
Yes, sir, visible.
Yeah. Okay, thank you. So hope I'm audible, or you want me to be a little loud?
No, audible, sir. Perfect, sir.
Yeah, okay. So, Satish mentioned about this foundation of mind. So let me introduce one part of mind. This is a foundation for financial freedom, strives for, because we believe in this principle, financially responsible citizen is critical to the country's economic and social progress. So we do quite a lot of program without any cost to the organizers in and around Madurai right now, due to logistics and availability of resource person. In schools and government schools and colleges, and to the teachers and as well as students at a very young age, teaching them about the importance of financially responsible savings and investments. It's not about stock markets. It's much more about savings and the importance of savings, not to borrow or borrow cleverly, borrow profitably, and the dangers of using credit card and all these things. So it's more that whatever government is doing on its own, we are trying to do it on from our side. So today's topic is an asset allocation, asset allocation during volatile times. Because asset allocation is a tool which really helps people who are busy otherwise with other profession or other business or other career to take care of or to mitigate the risk, and at the same time not to miss out on the major opportunities which the market provides. So this is a nutshell of this. And to some extent, the mutual fund investment also helps. So I'm going to touch upon that also. Now, the current scenario, look at the, where we are right now. It's an amazing dream run for Indian capital market. We could have never asked for, better than this. The last two times I remember we had such a similar run, or you cannot compare this run with that, but then something closer to this was the run in 1992-94, what we call as Harshad Mehta period. And then in 2008, not even 2001, 2007, 6-7 was the period where we had the huge market run. But I'm removing 2007-8 basically because it brought in volumes from FIAs, but it never brought in large number of investors. The large number of investors really came in 92. We had the investment, close to more than 20% of the Indian population was investing. We never had such kind of a thing. It has come down to 2% at one point of time, and now we have closer to 5% of Indian population investing in the market. So this rally has brought in investors to the market after 1992. This rally has brought in retail investors to the market, new investors to the market in a very big way than any other rally has brought in. The markets have doubled. The index has doubled in the last 1.5 years. Nifty has doubled. Sensex has doubled, or more than doubled in a way, at some point of time. And the reason being, the main reason being the lot of liquidity being pumped into the market by central banks world over. And in India also, in a way, to some extent, that's a fact. But more than that, in India, I think the sector which is doing extremely well is IT sector, the services sector. And in that sector, the salary levels have gone up. And the people who have, the youngsters who have a lot of money, excess money, savings, and they are all not like, my generation. They don't believe in building a house because they are global citizens. They don't know where they will stay. Today, they will be in Hyderabad. Tomorrow, they will go to Bangalore. Then they may be posted in US. So they don't want to buy a house. And when they don't buy a house, if you remove the EMI part of it from every middle class house, you will have really a big savings. Now, what do you do with that savings? You can put it in fixed deposit. That's how we really look at it. Next option for us is gold and fixed deposit for my generation. Now, this generation don't consider gold as an investment at all. And those who consider it also go to paper gold. So they don't look at gold as an investment. The next option is fixed deposit. Now, what is the kind of the return available? 5%. So they're not happy with the 5%. The aggressive at that age, they don't want to, park it in a investment which is yielding them negative real rate of return. Today, the fixed deposits or any such fixed return instruments are giving us negative real rate of return. The inflation is in double digits. Of course, when I say inflation, I'm conscious that the inflation is 11% is not the real 11%. It may be 15% for some, it may be 10% for some, it may be 5% for some, depending upon where you stay. Because inflation is, there is a rural inflation, there is a urban inflation. Within that, the inflation is different in north, inflation is different in southern part of the India. And then when you look at the wholesale price index, it is different. CPI or consumer price index, it is different. And particularly when you look at the peculiar situation where we are now, the WPA is lesser than CPI. You know, in a rarest of the rare situations, this happens. But no wonder I'm not surprised, basically, because more than 45%, I think 46% of CPI consists of food items, whereas in WPA it doesn't constitute so much. Whereas it is the crude and other things in a WPA. So this is there is a disparity between. So, but we have to take a ballpark figure. So the core inflation, which is about 11% or 10%, which is more than double digit. So the youngsters, this generation, from the tech sector, from the information technology field, don't want to invest a lot in fixed deposits or gold or real estate, but still they are left with surplus. They are attracted towards the capital market. They have come in a very big way. Coupled with that, what has happened is last year work from home culture. Because of this, there is no firewall, or even if there is a firewall or something, in their system, they have another system where they can trade from home. In the office, they were not able to do this. Maybe some of them would have done it with mobile. So this is another thing which has added thing. Now, this is very clearly reflecting. If you look at the number of Demat accounts opened in the last 1.5 years, it has more than doubled. We had somewhere close to 3 crores or 3.5 crores around Demat account. And the last numbers I have heard is more than 8 crores Demat account, which means more than 4 crore account opened in the last 1 or 1.5 years. In fact, BSE claims it is about 9 crore accounts opened, the UCCs opened. So the investor community has more than doubled in the last 1 or 1.5 years post-COVID, contrary to what many people thought about it when the lockdown was announced last year. So this is basically because of, like I said, the government pumped in surplus, central bank pumped in surplus, and then the individuals, the HNIs or ultra HNIs, and the individuals, retail investors. So it's a combination of all these things resulting in huge volume. Today, the ADTO, what we call as average daily turnover of NSE, is anywhere between 65,000 crores to 81,000 crores. And I mean, if you include the derivatives and all, it runs into several lakh crores. So this is the kind of the volume which takes place. And the market cap is 2,553. 2.55 lakh crore. That's the kind of things which is happening right now. So in this market, now what do we do? The question is, when in such a highly volatile, the same market started coming down last 1 month. Once the Omicron was that detected first time, I think sometime on November 17th or 20th, third week of November. So it has started coming down. Market has started coming down, and in between also market started came down and went up and all. There are headwinds. One is the inflation. It is not only the local inflation of double digit. Very surprised to hear that the US inflation is somewhere around 6.8% or 6.3%. It's more than 6%, which is 39-year high. In US, you are seeing negative rate of return because the rate of return offered by the banks are very low. So with 6% plus inflation in US, closer to 5% inflation in a country like UK, I think we are in for a high inflation going forward. Now, what will happen? This will result in people interest rate going up. When the interest rate starts moving up, people will generally take out money from the capital market and put it into fixed deposits. This is one thing which can happen in the capital market in the next year. And market anyhow is due after 1.5 years rally, starting from April 2020 till November 2021. In this last 1.5 years rally, the market is due for a correction, and market is waiting for a correction. Coupled with this inflation-linked interest rate hike, I think people might move out money from that. Now, does it mean a crash in the market? I don't think the market is going to crash. We'll discuss more on this later. Now, the point why I'm trying to highlight this is that this kind of the uncertainty we have faced in the recent past, 5 million jobs are missing in US. This is a data economist says, out of which 3 million has not come back yet due to COVID or early retirement or various reasons. Okay, and logistics, complete collapse, mismatch of container supply between China and other countries and other things. So, which has resulted in commodity prices going up like anything. I've never seen cement prices like this, steel prices like this in the recent past, which is leading to increase in the input cost for many. So these are all the things. In such a scenario, how do us an investor protects his capital? Should he have to pull out the money completely from the market and put everything into fixed deposit or fixed return instruments and be happy with 5% and negative rate of return compared to inflation? Or should he have to continue? There is also a fear of missing out, what we call as FOMO. When the fear of missing out happens, people want to win. That's what happened in the last 1 year. People never wanted to get out. They felt missed out. People who sold, who booked profit, also came back to the market again because they saw the market going up. So FOMO, in such a scenario, how to handle the market? And that is where this topic is becoming very, very relevant right now. Asset allocation during such volatile times. How do we handle this? And we are going to discuss about that with some practical examples today. Now, let's take a moment and look at this particular slide. Many of us, the common man, believe or you want to believe a comforting lie than unpleasant truths. And that's why, nobody want to fear, particularly I call the new entrants, forgive me, I just mentioned them, I call them as sophomores. The new entrants in the market, they have never seen failure. They have never seen the market correcting. Unlike the people who have entered the market in 90s and 10 years back, 2007-8. We have seen so many failures, 92, 94, again Y2K failure in market. I don't want to use the word failure, but market crash in 2001 and 2008, where the market fell down by 2/3 or 66%, and then the market fall of 2016 during demonetization announcement, and then the market fall during COVID, pre-COVID. So lockdown. So these are the times where we have seen market crashes. The new generation of 4 crore plus investors who have come into the market, they have not seen anything like us. So the problem is that once they feel a crash, we don't know how they will react. Will they panic? Will they take out the entire money, or they will take the part of the money, or will they make it as an opportunity and make use of it and invest further? We don't know. We have to wait and see. They have come with some expectations. Those expectations are fulfilled till now, but we don't know what will happen once they are disappointed. So unlike the veterans who know that whenever it falls, India is a great country. Indian economy will continue to do very well. Not because of the politicians, but in spite of the politicians. But once we have a good politician, it may do even better, but much better. So overall long-term growth story is intact. So when a fall happens, most of us veterans will try to make use of it as an opportunity to buy. But not these new people. We don't know what these new people will do. They always, the new entrant always, as a new entrant, I believe that market is never going to crash in late 80s or early 90s. But it was a big shock to me post that Harshad Mehta period that crash happened. And we learned a lot of lessons later. So this is what is now, and in such a scenario, what really helps all of us from facing the unexpected fall or unexpected rally is, and taking advantage, is asset allocation. Now, what is asset allocation? And all of us know, I think, successful communities or India, if you see pockets of communities in India, by nature, by the way they were brought up, they are very good at this asset allocation. And asset allocation is nothing but different, a sort of investing in different asset classes, so that we don't miss out on a particular rally in a particular asset, or also we don't get caught or trapped in a fall or crash in a particular asset by investing all our money into one particular asset class. It may be stocks, it may be real estate, it may be a combination of bonds or debentures or precious metals like gold, silver, or gold ETF, and a bit in cash also. And some of the communities I know, they also look at asset allocation, a part of the asset allocated to charity. They think that is also a big asset which they leave it to the children. So if you this is a asset allocation, but there is a people we get confused between asset allocation and diversification. True, asset allocation is a form of a diversification, but not exactly. There is a difference between the layers. The first layer is asset allocation, but within each asset class, we go for diversification. Now, this is what on the left side, what I call as asset allocation. And on the right side is diversification. Within the stocks, we try to invest a part of it in large cap stocks, a part of it in small cap, a part of it in mid cap, or a part of it in Indian market and part of it in emerging markets, part of it in developed markets. So, and in commodity, we invest a part in gold, diversify and invest a part in silver. So that is one way. In bonds, we invest a part, or debentures, we invest a part in government securities or treasury bills or something. I'll try to, I think if time permits, we can touch upon RBI Retail Direct. That's an interesting concept which now RBI has allowed retail investors to invest in directly in bond with as minimum as little as 10,000 rupees. I have registered myself in RBI Retail Direct, and I have done it also. I have invested in 6.99 bond, which is maturing on 2041. Look at it, 10,000 rupees you are investing, you're going to get close to 7% from a government bond up to 2041, which is a very good yield. It may not be giving as much as return as a stocks or this thing, but it does not carry a risk as a stock carries, and far better than the 5% return or 6% return offered by the public sector banks or other banks. So these bonds are auctioned frequently in primary market section, in secondary market section in RBI Retail Direct, where retail investors can directly participate, also through BSE Direct and NSE. NSE, there is a GoBid NSE. Also, GoBid NSE is an app. You can download GoBid NSE or BSE Direct and use them. Also, RBI Direct is a better option. I would say that you can link your bank account to it. I'll explain if time permits about it. So you can diversify within that asset class. So asset allocation is on top. 2-3 asset classes. Within that asset class, you diversify into different investments. So this is the basic difference between this. Each has got its own advantages. So basically, the risk mitigation and optimization of returns with minimal risk. That's the point. It's not elimination of risk. It's very difficult to eliminate risk. In fact, you cannot eliminate risk. Risk is inherent to markets. The risk is there in fixed deposits, what we have with the public sector bank too. The government itself accepts it. The possibility is there. You cannot rule that out. Though I'm not saying that it is risky or don't go and take all your money from the banks, but there is an element. That's why they give a coverage, insurance coverage of 5 lakhs, which was only 1 lakh till last year. This 1 lakh limit was fixed in 1992. We've been from various investor associations writing and requesting. Finally, the government and the finance minister listened to this and increased it to 5 lakhs. 1 lakh was fixed in 1992. And what is the inflation which has gone now? What kind of digital transaction which is taking place now? And how much of risk we are putting ourselves into the banking system with the kind of the NPS right now. So these are all the things, the difference between this thing. So risk is there inherent. We'll talk about systemic risk, systematic risk, and unsystematic risk, and how asset allocation helps us in handling those risks. So, if you look at this modern portfolio theory, the father of modern portfolio theory is Harry Markowitz. He mentions, he's a Nobel laureate. In choosing a portfolio, investors should seek broad diversification. Further, they should understand that equities and corporate bonds also involve risk. This he has said that long time back, many years back, even before 2008, MBS or mortgage-backed securities or CDOs, collateralized debt obligation, that crash happened because of CDOs and MBS. He says that they should understand that equities and corporate bonds also involve risk, that markets inevitably fluctuate, and their portfolio should be such that they are willing to ride out the bad as well as the good times. We think of the good. Last 1.5 years, we're only thinking of the good times. What will happen when a bad time comes? And in bad time, we only think of bad time and we never take advantage of that bad time. Then when the good time happens, we have the FOMO or fear of missing out. So he says that a portfolio should be structured in such a way that it should ride the bad as well as good times. That's the crux of it. Now, the modern portfolio, it provides the tools for identifying the portfolio which give the highest return for a particular level of risk. It's called the mean variance portfolio theory. And the total risk of the portfolio can be reduced by diversification to some extent. And this can be achieved by investing in assets that have low positive correlation between each other, but still a negative correlation, in fact. One small example I can tell you, if you are investing in an IT services company and a crude oil importing or a petroleum company. Now, both these have negative correlation because when the current account deficit widens or when the dollar goes up, the crude price indirectly goes up, the cost of crude goes up, whereas the IT companies benefited because the dollar goes up. When the dollar goes up, the IT companies or the exporters benefited or the importers are not benefited. So when you have a portfolio with these two companies, the risk of one company is eliminated by the risk generated by the other company. Okay. Now, what are the risks? The risk can be classified into various types. Okay, it can be global risk, international risk, or local risk, geographical risk, what we call. It can be health, can be medical, like COVID can be one risk, pandemic. So various risks are there. Broadly, we are going to look at systematic and unsystematic risk and then systemic risk. Okay. Now, as I said, there are global risk and country risk. Okay. There is political risk. If there is a problem in Iran, Iraq, or Middle East, then the crude price will face a problem. The crude price will go up. And because of which all our input cost for a country like India, which depends mostly on import of crude, close to 50% of our imports are on, crude and gold. So there is a political risk when there is a war which happens in Iran, Iraq, or Middle East. Then there are legal risks. What happened to ITC? I don't know how many of you remember. About 20 years back, when Kerala High Court, I think, Kerala High Court imposed a ban on smoking in public places. Then my generation people know those days, the moment you have lunch, people or the chain smokers used to go out to the tea shop, have a cup of tea, and then smoke and come back. And in many offices, within office also, they were allowed to smoke. And nobody can question them. So that was the situation. Suddenly, Kerala court banned smoking in public places, saying that it causes health hazard to those who are around you. I may be smoking, it does not affect me alone, it affects people around me. So they banned smoking in public places. It started with one state of Kerala. The price of ITC share price started crashing because everyone feared that every other state will impose a ban. Today, the ban is there, it's a universal ban. The smoking in public places is banned in the entire India. So, but what happened is there was a legal risk, but ITC cleverly tackled it, mitigated it later by bringing in a Sunfeast brand. They slowly changed from a 100% or 90% revenue coming from cigarette to less than 50% revenue coming from cigarette. The top line growth is now today 50-50 or closer to 50. Is FMCG product and other products, paper product, FMCG, and hospitality sector. So this is one way of mitigating the legal risk, but then by the company, but there was a legal risk. So you don't know what kind of legal risk you will face. And suddenly banning China, import from China, that can be a political risk, or there also could be an economic risk of slowdown happening, like it happened in many other countries. In India, hardly the slowdown happens. We are always 5% around average, but many other countries had the slowdown. For us, 5% it's a 4% is slowdown, 7-8% is a better growth, or 10% is even a better growth. So slowdown could be one risk due to which the profitability of the companies will come down, and probably sometimes companies benefit because lower interest rate. The companies which is borrowed might be benefited, but then it also affects them. So various risks are there. Then it is not only global risks or country risks, there are sector specific risks. Okay, sugar. The MSP or the selling price fixed by the government will have a bearing on the sugar sector. And sugar sector gets a subsidy for their exports. That's also fixed by the government. That have a, that's a sector specific risk. When it goes up, the sector is benefited. When it comes down, the sector is affected. That does not affect metals or cement or any other sector. Similarly, when the crude price goes up suddenly, it gets, it affects the airline industry or the travel sector or the transport sector. It does not, it has got a cascading effect on various other things, but not directly affect the sugar sector or other things. When the metal sector is affected, so similarly, it's a sector-wise, sector-specific risks are there. Now, we should be trying to address this sector-specific risk. Diversification helps in addressing this sector-specific risk. And to some extent, asset allocation helps us in mitigating some of the global risks, by investing in various markets, emerging markets, Indian market, international market, and all those things. So we spoke about global risk and country risk, and then sector specific risk within a country, and then now a company specific risk. For example, ITC is though it is a legal risk, it is also a company specific risk. And Infosys had a CEO issue some time back. It's a company specific risk and it affected the price, but again, it has come up. Tata's had when mystery was there was an issue, and that is a company specific risk and all these things. So this can be addressed in a different manner. Okay, now, yeah, interest rate risk. Of course, it's a little dated, this thing. When Russian ruble crashed, it was a root shock and the interest rates flared up like anything. Similarly, currency risk. When Nigerian devaluation happened a couple of years back, Bharat Italy share got affected in a very big way. The Nigeria suddenly announced a devaluation of their currency, and Bharat Italy has borrowed heavily, and their company share plunged because the borrowing suddenly went up. With the same amount of borrowing, because of the devaluation, the amount of repayment went up substantially. Then the commodity risk, which I mentioned earlier also, when until 10 years back, US never had any great oil production, but then they invented or they explored the shale gas, and from a country which was importing oil, they became a crude surplus country and started exporting crude. And that's when the crude price crash started happening. If you remember, many of you 10 years back or more than 10 years back, the crude almost touched $150 a barrel. From there, it came down to below $20 also. That is because of this main reason. And that also led to mismatch for some time in crude transportation of container ship and all those things. So there is a risk in steel and cement and all those things, various other commodities. So what is systemic, systematic, and other risk? Okay. Now, I would say the systemic risk is what we call as TBTF, or too big to fail. Okay, which happened in US in 2007-8. I vaguely remember sometime in March, the big crash happened in 2008, September, October, August, September, October. But before that, there was a hint in March. At that time, Lehman Brothers, Fannie Mae, and all, some of these companies, they claimed that they're 150-year-old company and they will never fail. And they were criticizing the companies which have failed. Within 6 months, these companies failed. That's all. It's only 6 months and these companies failed. And nobody thought that they will fail. And AIG, insurance giant in US, they failed because they insured these mortgage-backed securities or collateralized debt obligations, which was based on a collection of debt instruments rated at different level. And that debt instrument is created out of the loan lent to the mortgage companies, and that was given by mortgage companies to the home buyer. Look at, I'll show you one slide is there. I think I'll show you that how the kind of the confusion they have created. At one stage, the leverage was 1:99 by the banks and the financial institutions. In India, it is even today, if you look at it, 1:4 probably, the bank's leverage, the CRR, SLR, and whatever they have is 20-25%, and it's their own money is blocked in Government of India securities and other things. So only 75% is the public money, which is, which is lent into that. So the leverage is not very high. That's why we never failed in a big way. If our banks, the political system at various points let us down because of bad lending, but otherwise we didn't fail. But this too big to fail is a very dangerous thing. India, we had so many banks and other institutions, so it never happened there. There were very big companies which failed, which had a cascading effect on various other institutions. When the borrower fails, the lender fails, the lending bank or mortgage company. When he fails, the securities he sold to someone fails. And the someone who bought that security sold it to, grouped it into various asset classes and sold it to his investors. So they failed. And they insured it, on the assurance only they sold it to the investors. So the insurance company could not meet out all this entire obligation because so huge. They failed. Finally, government has to interfere and give. So this is a kind of a systemic fail which has got a cascading effect on the entire system. Okay, they are too interconnected with each other. It is a total system breakdown, and that's why in stock exchanges and many financial institutions have a disaster recovery site in a different location. If the stock exchange is in Bombay, they have a DR site in Hyderabad or in a different seismic zone, so that it does not get affected. This is another way of diversification and asset allocation is another way of having a disaster recovery site. And like various, I can keep on quoting various such incidences like tsunami, Mumbai floods, Kerala strike, earthquake. You have all your properties in coastal town of Chennai. After tsunami, the entire the real estate price crashed for a couple of years. If a real estate investment trust is having all its property only in that place, what will happen? So they have to diversify. Okay. Now, what is systematic risk? It is a risk inherent to the entire market or the entire market segment. And it is also known as undiversifiable risk, or though you can to some extent mitigate by diversification, but generally it is a undiversifiable risk or volatility or market risk. It affects the overall market, just not a particular stock or industry. But this is not due to the systemic failure. This is not due to the system. So people get confused with systemic risk and systematic risk. Systemic risk is different. Systematic risk is different. And this is also unpredictable and impossible, and it is completely impossible to avoid it. You have to face it. Okay, you cannot say that I have not invested in a particular stock, so I can avoid it. It will be across the board, so you cannot avoid it. Whatever investments you have, you can as it cannot be mitigated through diversification. To some extent, you can hedge the risk. That's what I called as mitigation, by using a right asset allocation strategy and also hedging it in the market to some extent using the derivatives. So this is one way of doing, mitigating or hedging it. I would not say mitigating, but hedging the risk. Okay, so systematic risk. Now, this is, this is example. What I give is that if you're, putting some in the bond and other in the stocks, it can it can mitigate systematic risk, because the interest rate shift happens in the bond. It's because of that, this can happen, and vice versa. It will the portfolio value change will offset that, and various things like interest rate changes, inflation, recession. You cannot avoid inflation. You cannot avoid the interest rate change or recession. It can happen. It will happen. Okay, it is not a systemic risk, but it is a systematic risk. It happens, but you cannot avoid it. And because it affects the entire market, and not by diversifying, you cannot reduce it, but you can hedge it. Okay, you can hedge the risk. If you are long on a particular asset class, you can go short in a derivative. To that extent, you can hedge the risk. That's all you can do. Okay, it's a broad. It affects a broad range of securities. Unsystematic risk is called diversifiable risk, because it can be mitigated through diversification, and it's called market risk, or it is inherent. So now I think I explained all these things. The systematic risk cannot be fixed with diversification, but can be hedged, okay, by using the various derivative instruments, swaptions or options, and all those things. Okay. Okay. I'm just in 2008, systemic risk was the major contributor, as I explained, and I think I have explained all these things. Okay. In simple terms, it's a ripple effect which happens because of a failure of a particular company. See, this is probably one reason that we don't want the entire insurance sector to be privatized, because or completely privatized. The government should still have some sort of a control, basic, because when everything fails, people come to insurance. And if insurance is also in a private hands, and if it fails, in US, what happened? Government provided facility or funding to the private sector insurance company, because if insurance fails, the entire country fails. So that is the reason. Yeah, I think it's a sort of a repetition of what I already mentioned. Okay, I'll take a minute to explain this particular this thing. And meanwhile, if you have any queries, you can start posting on it. I'll try to answer it around from 12 o'clock onwards. And see, this is the substance of subprime mortgage crisis created by a vicious cycle of lending and then renting to people who cannot repay, knowing very well that they cannot repay. Basically, because by selling more mortgages and by doing these people are highly incentivized. The bankers or the mortgage company executives and CEOs were highly incentivized. If you want to watch, there are a lot of movies on this. Inside Job is one such docudrama, which explains clearly that how these these finance companies were having the CEOs having private jets. They were owning several private jets, their holiday homes, with the incentive they have earned out of mis-selling, which happened to people who cannot repay, knowing very well they cannot repay. They were sold these mortgages. The fellow who had one house were asked to force or indirectly induced to buy another house, and with lower down payment, and with a holiday period of you need not repay for 1 year and start repayment after 1 year. These kind of things induced, and which led to banking instability. Now, what happened was, because the sale has happened, I mean, the lot of money liquidity was available, and they didn't know what to do, and they were highly incentivized. They gave money to people who cannot repay. And the people, 1 year later, when the holiday period was over, then they are not able to repay. They all put it in a cover, put the house key in a cover and send it to the bank, and they moved out of the house and stayed in the lawn, put a tent and stayed in the lawn. Practically, they came to the streets, many of them. They lost the job because of the decline in overall US economy. They were not able to repay. And since they were not able to repay, and more houses were returned to the mortgage banks, and more house supply came in. And added to this, there was a huge explosion the previous year. So they were building a lot of houses. If you remember, I think this happened in Hyderabad typically about 12 years back. A lot of excess supply of real estate was there. And last 10 years in Chennai, you can see that happening. So the housing prices started declining for two reasons. One is there was already a huge construction happening and excess supply was there. Added to this, the people who could not repay their loans started sending those houses, stop repaying, and that supply also came in. Now, that led to negative equity, or the home worth less than the mortgage. Mortgage given was $10 million, and the home was only $8 million. They were not able to recover, and they could not sell it even for $6 million. And the homeowners walk away with involuntary or foreclosures increased supply of homes, which led to market payment decline, and which led to the value of mortgage-backed securities. Because as I said earlier, once they lend it, the mortgage companies lend to the house owners, they sell this as a bond, or they sell these mortgages as a security to mortgage-backed security to some big investing companies, and that companies sell it to their investors. So the value of mortgage-backed securities declined. Okay, and then the banks started incurring heavy losses, and because of which the lendable funds from the banks declined. they were not able to lend further because of mounting losses and non-performing assets. So they started restricted lending, which led to economic activity slowdown, and because of which unemployment increased. And because unemployment increased, again, those who are already employed, still they have not lost their job. They've lost their job right now. And because they have lost their job, now again, they don't, those of them, the rest of them who are paying their home loans, they didn't pay the home loan. So this vicious cycle started. More supply of home, more unpaid loan, and more decline in mortgage-backed securities, banker incurred loss, and the insurance companies which insured these bonds incurred heavy loss. So this is what happened during this period. And the US market, Dow Jones index came down from 14,000 to 7,000. It fell down by 50%, which is one of the highest in the recent past, in the last maybe about a century, I would say, of the Dow Jones period. Whereas in India never had a decline, economic decline, slowdown. We still had 5% growth during that year, if my memory serves me right. But our market, Sensex, came down from $21,000 to 21,000 level to 7,900 or around 7,000 levels. It lost 2/3, more than 63% or 64% fall happened in that year, particularly for no fault of India. And when that happened, many Indians also lost money. Retail investors lost money. DIS lost money. Of course, DIS made a little money because they were booking profit continuously, cleverly earlier. Okay, so that way, but ultimately they also lost money for a brief period. Next year, the market went up by close to 79% or 80%. That's a different story. So in 2008, the market crashed by 64%, and 2009, market went up by close to 79%. Now, everybody sold in 2008 when the market was low, and everybody bought when the market was high. And because they bought, the market went up. Because they sold, market came down. Actually, we should have done the reverse. We should have bought in 2008 when the market crashed, October, November, December. And we should have sold in 2009 when the market went up in November, December. We did the reverse. Most of us did the reverse. Why? Because we never had a proper systematic investment plan or asset allocation or diversification. Had you had your asset allocation or diversification, automatically we would have done this. Okay, I'll show you the next an Excel sheet which I have. You're able to see the Excel sheet? Yeah. Okay. Now, this is in simple terms what asset allocation does to you. You have 100 rupees. Now, what you do is that you divide it between safe asset classes. I mean, typically when I say safe, nothing is safe today. But we just say that we divide 50 into safe and 50 into risky, like commodity, stocks, or currency. 50 into safe, like fixed deposit with banks or post office or whatever it is. So you have 1 lakh. Invest 50,000 into safe asset class and 50,000 into risky asset class at the year beginning. At the end of the first year, your safe investment would have gone to 54,000. I assume a return of about 8%, 7 to 8%. And your risky asset class would have given about 15% to 18 or 18% return. The index has given on an average 17 to 18% return in the last 30, 40 years. So I've taken that as average. I'm not taken the 80% return which it has given in 2008. Or 100% return, which it has given in the last 1.5 years. I have not taken the negative return also. I am taking negative return later.
Sir, so, sorry to stop you.
Yeah.
Members, we cannot see Excel sheets, sir. I think, sorry, my mistake also. Only the PPT is appearing, Excel sheet not appearing, sir.
Okay, 1 minute, sir.
1 minute, please.
I think I have to stop share and again go back to that.
Yes, sir. I think you can minimize and I think.
Yeah.
Yeah. Now it is appearing, sir.
Yeah.
Yes, sir. Yeah.
Okay. So as I was mentioning, you have 1 lakh in the beginning, and you have an asset allocation of 50-50 between safe asset class and risky asset class. Now, this 1 lakh, we divide 50,000, we invest it into fixed deposit. 50,000 we invest into an index fund, a Nifty index fund. Let us see, for ease of understanding, let us not confuse with too many asset classes. So 50,000 we have invested at the beginning of the year into Nifty mutual fund or ETF, and 50,000 we have invested into fixed deposit. At the end of the first year, I presume, based on 7 to 8% return, the fixed return would have given 50,000 would have become 54,000, and the equity of 50,000 would have become 60,000. Just for example, I'm just giving this. I'm not taking the extreme levels. I'm just taking moderate high, moderate low. Okay, 60,000. Now, at the beginning of the second year, which is post the end of the first year, it is same 1,14,000. It will be there beginning of the second year. Now, what you do is you have 60,000 in equity, 54,000 in safety, but your original is 50-50. The asset allocation is 50-50. Is it 50-50 now? No. The 1,14,000 is divided into different ratio, not into 50-50. So what do I do? You remove 3,000 from 60,000 by selling 3,000 rupees worth of stock. Take the 3,000 out and put it into fixed deposit. Add to this 54,000. 54,000 become 57,000. And because you are selling 3,000 in equity, 60,000 become 57,000, a total of 1,14,000. Now, at the end of the second year, your 57,000 in fixed deposit becomes 61,000 approximately, and 57,000 due to market fall become 52,000. Market falls by, let's say, about 10% or something, 8%, so 52,000. The total is 1,13,000, which is less than 1,14,000. Okay. Now, the third year, what you do is you divide this 1,13,000. You have, it is not 50-50 between safety and risky. So you remove roughly about how much it is, about 3,500 right there, 4,500 from safety fixed deposit, break it, and add that 4,500 to equity. You invest in equity. Okay. It becomes 56,500. Now let me go back and see what we have done. In the first year end, when the equity has appreciated and gone to 60,000 rupees from 50,000, we have taken out, booked profit and taken out 3,000 and parked it into safe asset class. In the second year, when equity has fallen down and become cheaper at 52,000 rupees, we have taken out that money which we parked last year and a little bit extra and put it into high risk asset class at a lower level. Now, what happens is because of this asset allocation, without us realizing, we keep booking profits when the market goes up and park it in a safe asset class. And we keep investing when the market comes down. We buy at a cheaper rate. So this is the benefit of following an asset allocation model, where mechanically using a simple Excel sheet, you can benefit out of the rises in market and take less hit when the market falls, and also park your profits, the siphon off or take your profits and put it in a safe asset class when the markets are doing very well instead of panicking. These are the benefits of that. And I've done the similar working up to this. So at the end of the 5 year, you have about 1,60,000. Had you invested this 1 lakh completely into fixed return instrument, it would have been somewhere around maybe about 1,40,000 or 1,45,000. You've got the 10 to 15,000 rupees extra because you have invested in this. Now, should it be 50-50? Why not it be 40-60 or 60-40 or 80-20, 20-80? It can be. It all depends upon your risk appetite, what age group you are in. Are you young? Are you old? Can you take this risk or you cannot take this risk? What kind of the way you are brought up, your surrounding, your family, the mindset? Is it totally averse to risk, which means you'll panic? Or you're brought up in such a way, or your mindset in such a way that when the market crashes, you don't panic, but you look at it as a golden opportunity to buy. So these are all the things which decide. And time frame, you want the money within 6 months or 1 year, or you want the money in 5 years or 10 years. Depending upon that, you can increase. If you want the money in 5 to 10 years, you can go for equity. If your risk appetite is high, you can go more for equity. If you are looking at liquidity, it is better you go for other asset classes. If you're looking at safety, you go for other asset classes. You look at short term, you go for other asset classes more. So depending upon your risk appetite, your safety angle from which you're looking at, and the time frame or the goals you have in mind, and the timeline needed to meet it, and the liquidity you require, you can follow probably 100 minus age rule, which we generally say. You minus your age from 100, and to that extent, you can take equity. Now, my age is 80. To that extent, you can put your money in fixed return instrument. Now, my age is 20. Let's say 25. and 100 minus 25, 75. Now 75 will go into equity. The rest will go into equity. Now, as I grow old, I become 40-year-old. 100 minus 40, 60. Now 60 will go into equity. Earlier, I had 75 into equity. Now I'll sell 15% and put it in the fixed deposit and increase my fixed deposit from 25% of my total assets to 40% and reduce my equity from 75% to 60%. Why? Because as I grow old, my capacity to take risk might come down. My mental, strength to face losses might come down probably. And if I lose money, my capacity to earn also might come down. So I don't want to do that. But this is not a fixed rule. Let me also tell you, this is not a fixed rule. I remember meeting an 80-year-old man in a meeting. He came and told me that, sir, why do you say that I should take less risk? I've seen my great grandchildren now and I have enough money to take risk. I don't have any other expenses. So I want to take risk. And I spend time usefully by watching CNBC TV or something, reading the Dalal Street magazine and interacting with my auditor. Even at the age of 80, I'm able to spend time productively. I don't mind losing 1 or 2 lakhs, in a month, but I do gain over a longer period of time. I don't mind taking risk. So it depends upon how deep your pockets are, what risk you can willing to take. You can increase this asset allocation, but by and large, it is better to have 100 minus age rule. This is a generic advice. And I've not included in this calculation the dividend given by investing in equity. It is purely capital return given by the index, which is on an average 16 to 18% over the last 30 years. Okay, which is almost 3 times the return given by a bank fixed deposit today. Apart from the tax benefits it gives, the up to 1 lakh long-term capital gain is not taxed. More than 1 lakh also it is only 10%. And also, if it is a short term also, it's only 15%, not your 20% or 30% in case if you fall in the tax bracket. So all these kind of short-term capital gain tax benefit, long-term capital gain tax benefit, long-term capital gain exemption benefit, carry forward of losses. So various benefits are there in equity. So I think this is why equity should play a dominant role in your this thing. Now I'll share the other screen. Okay, I think we were in. So this is one thing. Yeah, and this is what led to that mortgage-backed or asset-backed securities is the or collateralized debt obligations. These are all the things, and also, added to this, they had another interesting product called credit default swap. That is another thing. So these are all the things which led to the crisis of our subprime crisis in 2008. And Government of America, USA, brought in a scheme called TARP, Troubled Asset Relief Program. They lent against or they gave money against this troubled asset. We have the asset reconstruction companies in India, something similar to that, not exactly that. They did it. And they went for amazing quantitative easing, which they did last year in India also. Quantitative easing, US last year they did quantitative easing like anything, and which led to inflation, which led to rise in interest rate, which led to a lot of other problems. Okay, and of course this is what I mentioned. When somebody who cannot repay the loan, it's called jingle mail. They put the key in the car and they send it to the mortgage lender because they're not able to continue the payment. And I mentioned, in short, just to show that in a chart, what is a systematic risk and what is the unsystematic risk. Of course, we are very clear that systemic risk is totally different. And systematic risk is uncontrolled by an organization. It's macro in nature. Unsystematic risk is controllable by an organization, like what happened in ITC. They changed their business portfolio and it's micro in nature. And systematic risk includes inflation risk, price risk, interest rate risk, market risk, purchasing power parity, all this, demand inflation risk, cost inflation risk, directional, all these things, non-directional volatility risk, reinvestment, all these things are there. Unsystematic risk involved business risk or financial risk or credit risk or operational risk, people risk, a set of people leave a company, then the company collapses. It has happened in the case of few companies also. So these kind of risks are also there. And okay, I think this again it's a sort of a this thing. Okay, there's a difference between asset allocation and how we do the hedging and control this risk. Sort of repetition. I'll skip this. Yeah, I think this chart clearly explains how the systematic risk cannot be controlled beyond the level by using diversification. Just because you diversify more, it cannot control the systematic risk. It only controls the unsystematic risk. Okay, so next, when we talk about asset allocation, we have to also talk about larger perspective of market cycles. There is an interesting book which I will tell you, written by Howard Marks, the CEO of Oaktree Capital, on the market cycles, which was released, I think, last year or the year before. Very, very interesting how to take what are market cycles, how to take advantage of market cycles. It touches upon various other things, but this is a different thing what I am talking about. Slightly quantitative. Wave is a Russian economist, Nikolai Kondratev, and he refers to cycles last between 40 to 60 years, long-term cycles experienced by capitalist economies. When many of us talk about cycles of 4 years and 8 years, somebody like Warren Buffett tried to make use of these cycles. A company called Washington Post, if I'm Washington, I'll come back to the name of the company, which has got nothing to do with this. He invested in 1970s. It never appreciated for the next 23 years, but it gave 10,000% return after 23 years. I'll tell you the name of the company. But so this is the kind of this thing which, if you start early at the age of 20, 25, you can take advantage of these kind of cycles. Of course, the cycles are getting shortened nowadays due to technological advancements. It's not the same 40 years or 60 years like it used to be earlier. So it's called super waves, K waves, surges, long waves, and all. Okay. And in the recent past, in the last 200 or 300 years, if you look at it, how this has happened. The first cycle happened with the invention of steam engine, and between 1780 to 1830, and between 1830 to 1880, next 50 years. The second cycle, because of steel industry and the railroads, the invention of railroads happened. And the third cycle of this one happened between next 50 years, between 1880 to 1913, when electrification and chemical industry grew in a very big way. Okay. And the fourth cycle was fueled by autos, petrochemicals, which lasted between 1930 to 1970, which continues even today, but not to that extent, not that aggressive. Okay. And the fifth cycle, as we all know, when my generation, we know that the information technology, which began in 1970, because many of us didn't know Tata Consultancy Services was there much earlier than that. One of the oldest IT company in the world is TCS. We ran through the present. So the sixth wave is going to be driven by biotechnology, and healthcare is what, or mental health is some people discuss about. Okay. Now, how these cycles happen? This got 4 stages, like in our weather or climate. Spring, where there will be typically an increase in productivity, and because of inflation will be going up, and there will be an economic boom. And then the next level will be, which they typically call it as summer. There will be a affluence level will increase because the productivity has gone up. Because of the economic boom, the salary levels have gone up. More people would have got job, so the affluence level have gone up. The standard of life would have gone up. The attitude change to the attitude towards work would have changed. So there will be a deceleration of economic growth, because once you grow and become comfortable, you will talk about, instead of 6-week day, 5-week days. And like in many of the European countries, 4.5 days weeks, you will start talking about 4.5 days week. The quality of life goes up. You don't want to work that much. You don't work put into that kind of a hard work you put, because you already have a lot of money, and slowdown happens. And then the autumn, stagnating economic conditions give rise to a deflationary growth spiral, and it gives rise to various other policies. Okay, and it curtails the growth prospects. And then comes the winter. The economy throws up, trade depression, and it has the social fabric of the society. And the Gini coefficient, what we talk about, Gini coefficient widens, it goes up. The difference between haves and have-nots increases dramatically. And one can spot these cycles and take advantage from it economically and financially. So this is in chart. This is the last 5 quantitative waves, and steam engine, 1800, 1850 railway steel, and 1900 electrical engineering and chemistry, and then 1950 and petrochemicals wave, and information technology right now. So this is the book which I spoke about, Mastering the Market Cycle by Howard Marks, and getting the odds on your side during these different market cycles. And the advantages and drawbacks, and what happens in excessive high and what happens in excessive low is quite obvious, and many of us know what happens during that such time. Okay, and now we talk about asset allocation. Within that asset allocation, diversification of risk is also important, and I will touch upon that. We all want, there is 2 types of investments. One is fixed return, another is variable return. Okay, so fixed return is coming from fixed deposit. Variable return comes because of capital appreciation. Fixed return is a return on investment. Variable return is, most of the cases, it is capital appreciation. For example, in gold, you don't get any fixed return except sovereign gold bond, but what you get is a variable return. In real estate, what we get is a variable return, most of the land. But in homes, we get a fixed return probably. So it depends. And what is risk? It's the potential of losing something of value. It could be physical health, it could be social status, it could be emotional well-being, or financial health. Many people think that the moment I say risk means it is a loss. Risk is not equal to loss. Risk is the possibility of a loss happening or not happening. Okay. And risk perception is also, again, very subjective, and it's judgmental. Many people think about its severity as a highly severe, highly possible, and it may vary from people to people. And one has to understand the risk properly. We always say that the highest risk is not taking risk, because the chances of outliving our savings is there for our generation currently right now. Thanks to medical advancement, most of us are going to live maybe 85 years or 90 years. We don't know, maybe more than that too, because of medical advancement. But the quality of life may deteriorate, but then we are going to live because of the medical advancement. But at the same time, the job security has gone completely. When I joined my company first, I remember that my boss told me that, Nagapan, as long as you are honest, you will retire in this company. We will not remove you. Your inefficiency will not take you up, but it will retain you there. We will not sack just because you are inefficient, but we will sack you if you are dishonest. Otherwise, you will retire from this company. Today, our children join a company. Tomorrow, they are in a different company. Day after tomorrow, they are in a different company. Of course, they do get a salary, to what we got, retirement, when they are getting a salary when they join. But the job security is not there. We don't know when they will retire, when they will be out of thing there. So what I'm trying to say is that they will be having a life, earning life of 20 to 25 years, unlike most of us who had 30 to 35 years. So the earning period is reduced, but the non-earning period has increased substantially. My father, our fathers lived post-retirement 5 years, 10 years. Now we are going to live for 30 years or 35 years. They are going to live even longer post-retirement. So without any earning. So unless otherwise they look at proper diversification, financial planning, and take risk. The highest risk what they are going to take is the chances of outliving their savings. That's the biggest risk. We will outlive our savings. So we know that low risk, low return, medium risk, medium return, high risk, medium return, but most of us want low risk and high return. I'm not saying that it is not possible, but it is very difficult. Okay. So some of the examples of fixed deposits with banks, postal savings, Kisan Vikas Patra, all those things, some of them are outdated. Now, the most recent one is RBI Retail Direct, where you can invest in Government of India or state government treasuries, bonds, by logging into this RBI Retail Direct website. As little as 10,000 rupees can be invested directly by an investor. And most of the securities carry anywhere between 6.5% to 6.99%. And with a maturity of a few years to few decades also, some of them. And so it certainly as a part of asset allocation, I am looking at RBI Retail Direct, investing through RBI Retail Director. I have invested in one of the bond at 6.99%, maturing on 2041 in RBI Retail Director. So, and there are other options like gold, sovereign gold bond. Though gold is a different thing. We'll look at each one of this if you have time. Well, then there are some questions. Okay, there are two questions. I'll just
Yes, sir.
I'll explain it as and after this. So so there are these are the examples of medium risk, and high risk. Pure equity fund should come here as a high risk, and there are various other products which are available. Like the new latest addition to this is not really latest, but a few year old is REITs or real estate investment trust, which are reasonably good for diversification, like how you are diversifying into gold or this thing, real estate investment trust. For those who want to invest in real estate with 5 lakhs or 10 lakhs, but cannot invest because the real estate costs a few crores. I think we can certainly look at real estate investment trust, though it is not as on date, it is not a tax efficient investment because of various payouts which happen. For example, the taxation of the money you receive from real estate investment trust. There are 3 real estate investment trusts which are listed today. Embassy Parks is there. REITs, BARET, BARET. That is the Brookfields is there, and there is one more. Okay, there are 3 REITs are listed and traded with reasonably good liquidity in the market today. There are market makers, and the drawback could be that the advantage is that it is reasonably diversified across geographic area and across, more than 50% of the revenue should come from real estate investments only. For in abroad, there are some other investments also they make, but we are more than 50% of the revenue should come from real estate investment. More than 80% of the investment should be in rent yielding real estate. So to that extent, it is protected. So these are all advantages. Liquidity is there. The drawback, diversification. But the drawback is when you get a return from them, it is taxed based on, it is very peculiar, how the return comes. And the company is supposed to tell you. They don't tell you, you may not know. If how they pay, if the company is booking a long-term capital gain, selling a property and then returning the money to you, or the company is renting out a property and giving the rent to you, or the company is getting a dividend from a special purpose vehicle which is launched to buy a property and rent it out. And that special purpose vehicle is renting it out and returning that money as a dividend to the parent company, which the company is returning to you. So it depends upon how you get it. It is taxed at a marginal rate or 10% long-term, short-term capital gain or different thing. I think it needs a separate session to be handled. But just keep it in mind that it is a good thing to diversify into REITs, but not a tax efficient method to look at it. And the yield is anywhere between 6 to 7% is only they are working out as of now. I mean, looks like it. Unless otherwise the property price appreciates substantially later, and which you get it. So that's this is in short, asset allocation is capital allocation, and then within that security selection is diversification. And now, how do we do that? I mean, I'll touch upon just 3 different asset classes in diversification. Okay. Now look at the gold price between September 2002 to May 2009 or 10, probably 2010. It had a rally till 2011. What a big rally. I remember in dollar terms, I was trading at $285 or less than $300. From there, it went up to $1,850. Within a matter of 10 years, it appreciated from less than $300 to more than $1,800, which is an appreciation of about 6 times in less than 10 years. Gold has hardly given such kind of a return in the recent past. But why that happened and how that happened? It happened basically because it went through a longest bear run just before that. Starting from 1980, the oil crisis or oil rally happened in 1979-80, because of which gold price went up to $850. From that, in 81, it crashed to $150 or $180, I think. From 1980 to 2001 or 2002, the gold price never went up. It was always between $250 to $300, less than $300. 20 years, it never went up. Many in India never believe me when I say this, because in India, gold price went up. Why? In India, actually, the gold price did not go up. What went up was the dollar value. American dollar value went up, rupee depreciated. Two things happened. One is rupee depreciation. On an average, rupee depreciates by 3% per annum in the last so many years, if you look at it. On an average, it is 3% depreciation. So the gold would have automatically gone up by 3% to that extent. The second thing is American dollar on its own merit appreciated. Okay. Now, why should it affect gold? Because we don't make any gold. I think major part of it we import, 90% plus or 99% probably. So when we import such gold, or 100%, when we import such gold, we pay in American dollar. So we go and buy American dollar. When we import more crude and more gold, we need more American dollar. When the demand for American dollar goes up, the price of American dollar goes up. So we buy more dollar, the price goes up, again we buy. With that, we buy the gold. When we translate, we convert it into higher rate of dollar into rupee. So naturally, in 1980 to 2000, gold price never went up even by 1 rupee. It went up because the dollar appreciated. So that is what is the fact which we should keep in mind. So there was a long time correction which happened, post which the demand for gold went up. So gold started going up in 2002-03. But it went up, it should have gone up only to $600 or $500, but it went up to $1,850. Why? Because a new set of investors came into the market, the youngsters, the Y2K group, millennials, who don't believe in gold as a jewelry, but they believed in gold as an investment product. For them, the world's first gold ETF was launched in the year 2003 by SPDR, iShares. They launched the world's first gold ETF, exchange traded fund, in the year 2003, which made many people invest in gold ETF. And for every unit of gold ETF we invest, they buy 1 gram of gold. And when they buy, they actually buy physically and they keep it in their locker. And if you go to their website, they keep publishing the audited report with the gold bar numbers. Unlike India, when we invest in gold ETF, I don't remember last time when I have seen none of the gold ETF publish these details. When I checked up, the audited report was there, but then it didn't contain the details and all. There, the bar numbers, it's a unique bar number identified now. HF in India also, now that HF ID or something has come, that gold ornaments are identified. So with that ID, the gold bars are mentioned, and they used to publish the pictures also those days, where they have sold it in a bank. To that extent, transparency was there. So many youngsters started investing in gold ETF, which in turn invested in gold. So the gold price had a fantastic rally. Coupled with this, the third reason is quantitative easing, Greenspan effect. Greenspan effect, the US Fed chairman started pumping in a lot of this thing into the market, which went into various asset classes, which included crude. The crude went up to $150. The gold went up to $1,850. The stock markets went up to 21,000, in India, and 14,000 in Dow. Okay. So this is the history of gold till 2010. Now look at this, 2012 to 2015 or 16. Next 4 years, the gold price crashed from $1,850 or $1,900 per troy ounce to $1,100. In fact, very briefly, it came down below, closer to $1,000. So $1,100. Okay. This is the kind of the fall which has happened, which means it has lost more than 1/3 of its value in those 4 years. Between 2012 to 2016, it has lost more than 33% of its value internationally, and even in India. In India, the gold was trading at 3,000 plus in 2012, 11-12. From there, it came down below 2,500 in 2016. In spite of dollar appreciating, if you reduce for that, it will be still lower. And this is the first time in the recent past, post 2001, in the 15 years, the gold price came down. So many people exited gold. Now, from 2016 onwards, 17 onwards, probably the gold price started going up again. Okay, the third chart tells you that it went up to $2,000. It almost touched 2,000. I mean, crossed also $2,000. From $1,100, it had a rally of about $850, $900 in the last 3 or 4 years, or maybe 5 years. Okay, it appreciated by more than 50% or 60% in the last 4 or 5 years. Gold appreciated. Now, did we participate in such a rally? As far as I know, most of us never participated when the gold price came down from 2014 to 2018. We're always hoping for gold is a commodity. We go and buy when the price starts going up. We don't buy it when it is falling because we expect it to fall next day. If it falls tomorrow, I'll go and buy tomorrow. Why should I buy at higher level? So even, of course, in market also it happens. So this is what happened in gold. But had we followed the asset allocation policy, we would have naturally sold in 2008 in stocks, 2006-7 in stocks, and invested in gold in 2007-8. And we would have sold gold in 2009, 10, and 11, and invested in stocks in 2011 and 12. And because those are the times the market came down and went up. It's a complete different correlation, except there was a total correlation, positive correlation between gold, real estate, stocks, and crude, all asset classes from 2003 to 2007, which is very rare. It never happens. It is always a diverse correlation or inverse correlation, which happened from 2008 onwards. Had we followed an asset allocation policy, we would have taken advantage of this and sold stocks in 2006-7 and bought gold. Sold gold in 2011 and 12 and bought equity in 2013, and sold equity in 2017 or 18 and bought gold, part of it, and sold gold in 2019 and bought gold equity. So this is what would have happened had we followed asset allocation policy. This is a chart which I was mentioning about gold from the year 1975 to 2020. You look at such a long downward rally between 1980, when it touched during the oil crisis, $800 to $850. From there, it came down to $275 or $285 in 2002. When I first started trading in gold, because MCX launched gold futures at that point of time, I started trading in gold. So that is the time. And from then onwards, there is another thing added to that, was that MCX, or the Commodities Exchange, launched gold futures. That took up the gold to $1,800 or $850. So this is the gold. Now, if at all we decide to invest in gold, physical gold is never a good option. When I say asset allocation, people go and invest in gold coin or gold jewelry. We never sell gold jewelry in our life, Indians. And we buy, unlike Europeans, we don't buy 14 karat gold or 18 karat gold. We buy 22 karat gold and sometimes 24 karat gold coin, right? And when it appreciates, we don't sell it. Then what is the point of asset allocation? Don't call it an investment. Buying a jewelry for wearing is different. But when you say that it is an investment, we buy something at 100 rupees, goes to 125 rupees, we should sell it and book profit. That is what is called an investment, or booking profit and take out that 25 rupees. That's what we should do. We don't do that. So this helps us. Sovereign gold bond is something which is very important, because this is the only gold asset class which also gives a return of 2.5%. When I say 2.5%, many people tell me that it is too low, sir. You tell me which other gold investment which gives any return. None of them give a return. This is the only gold investment which gives a return, which also has a tax benefit, unlike other gold investments. When you, after 8th year, when you take back your money on maturity, it is completely exempted from the capital gain tax. There is no income tax, tax at all on the capital gain. Whereas if you invest in other things, your regular LTCG applies, 3 year plus 20% or whatever it is, that applies. Okay, it doesn't happen here. So there is a tax advantage. There is 2.5% return over a period of 8 years. It gives you 20% reasonably. Even if your gold price comes down by 20%, this 20% takes care of it, return. and it is issued by Government of India through RBI. So that is always there. You can pledge it. And for those who are worried about liquidity, there is enough liquidity to sell a few hundred in a day. You cannot invest more than 4 kilos in sovereign gold bond. Buy minimum of 1 unit, and you can, it is listed in Bombay Stock Exchange and NSE. Buy today, tomorrow you can sell it. So there is enough reasonably good liquidity is there to sell a few hundred sovereign gold bond. So one should, as a matter of diversification, when you look at it, 5% or 10%, whatever you want to invest, look at sovereign gold bond. Now look at real estate cycle. In a volatile market, how real estate behave. This is the data published by, taken out from RBI thing by another agency. It also talks about the nominal thing and the real thing after adjusting for inflation. In fact, it is negative. The return given by All India House Price Index, based on the annual percentage change, is negative steadily from 2011-12. It went up from 1995-96 to 2007-8. From then onwards, it started coming down. We don't realize it because of the inflation, but the inflation adjusted, if you look at it, it is low. Okay. One classic example I can tell about gold and real estate, because our mind is so attached. Many of your clients, you've been advising your clients as a chartered accountant, and many of your clients may be attached to real estate and gold. Nothing wrong with it as long as it is one house, because it is a good hedge against inflation. I don't agree with the millennials who say that I don't want to buy a house at all. You need one house at least. But then you can, going beyond one house, you are preventing ethically somebody else from buying a house because you buy two houses, the house price goes up. Okay, you don't want to sound too ethical. I mean, let's not talk about it. The other side of it is that when you buy it, when you're the supply is affected artificially. What happened in US may happen here, and you have a skewed asset allocation. Your asset allocation goes more into real estate and more into gold. What happens? Both are giving negative rate of return many times and compared to equity. Okay, so and it takes away a major chunk of it. I tell them only one thing. Those who don't want to get out of gold, I tell them only one thing. Really apply your mind and analyze. The shops which were selling gold to us in the last 30 years back, they were selling from a single-story building. Today, they all sell from an 8-story building. And we are still in the same single-story building or a single apartment, going to the same place with the same vehicle. Okay. Now, which means the sellers of the gold have minted money than the buyers of the gold. Still, the gold has got a role to play as a part of asset allocation. Take a look at it, but don't over-invest in gold and real estate. Have a proper asset allocation. Don't have a skewed asset allocation. And this is the return. Index has given in 1990. I remember 91 or something. The Iran-Iraq, the conflict happened, and the first Scud missile was launched. The market crashed below 1,990 or something Sensex. Which means if you have invested 1,000 rupees 30 years back, it will be 60,000 rupees now. In 2001-2, the index was around 3,000. If you have invested 3,000 rupees 20 years back, it will be 60,000 rupees now in stocks. Does it mean that you should invest all your money into stocks? No. It also had its own fair share of fall. 2008, it fell down by more than 60%. In 2016, it fell down in a very big way. It had its own cycle. So look at asset allocation. That's what I keep on repeatedly telling. Go for asset allocation. Within the assets, go for mutual funds. Go for this. And one thing which can help you is mutual fund. Okay. Now, the asset allocation also helps us from one more thing, our psychological bias. Many of us have psychological bias. I remember one of the very, very, very renowned chartered accountant who have served various organizations. I was having a conversation with him long time back. A well-respected gentleman, one from CA community. He asked me about stocks and investment. I said, sir, so what do I know more than you? Then he made this a very profound statement. He said that if numbers are something which is required to win in the stock market. All chartered accountants will be crorepati's and billionaires, which is not the fact. We are all writing accounts for other crorepati's and billionaires. So there is something else. What that is? And that made me think, and I started looking at specialized in a subject called behavioral finance and behavioral economics. How we all behave as a herd mindset, in spite of learned people, well-learned people, studied people, and then we can read annual report like a back of the, I mean, easily we can, we know what is the cash flow, what is the fund flow, what is the top line growth, bottom line growth. In spite of that, we keep making mistakes. Why? It's a psychological bias, confirmation, various bias which happen. For example, one such bias is called loss aversion theory. The theory says that the pain we get from a loss of 100 rupees is much more than the joy we get from the gain of 100 rupees. Our mindset, we are happy for 100 rupees, but we are much more painful. We experience more pain when we lose 100 rupees. We don't want to lose, because of which we hold on to a loss-making proposition. You bought a stock at 100 rupees, you know that it is a bad decision you made, you realize it after some time, but you still wait for it to go to 101 rupees and sell it. You don't want to sell it at 90 rupees, knowing very well it may go to 80 rupees also, because of which you lose, instead of 10 rupees, you lose 20 rupees. This is called loss aversion theory. And second thing is confirmation bias. Once we buy a stock, we simply look out for somebody else to confirm, a newspaper to confirm, a press report to confirm, a TV to confirm. We keep on looking out for it. If something is contrary, we simply ignore it. So this is something. Similarly, anchoring bias, in the typical gambler's fallacy. These are various things which you can read about it. And one such thing as anchoring bias is a typical case study. What we talk about is, now let me talk about two different examples. The first case scenario is that you want to buy a television for 10,000 rupees, and the television is available near your home at 10,000 rupees. You go to buy the television. The shop owner tells you that, sir, if you go outside the city, you will be, our own showroom, our own warehouse is there. You go and pick up from there. You will get 10% discount. It will be only 9,000 rupees. The studies show that majority of us, at least 68% of us, will go there and take delivery from there for that 10% or 1,000 rupees discount. The same scenario, you look at it, you want to buy a car of 10 lakhs. You go to the showroom, which is close house, and want to buy it. And he says, sir, if you buy it from here, it is 10 lakhs. If you go to our workshop, which is a few kilometers away from the city, and it is available at 9,99,000, most of us will not go. Now, if you look at the case, in both cases, we save 1,000 rupees. When we buy TV also, we save 1,000 rupees. When we buy here also, we save 1,000 rupees. But why we go to buy TV there and why we don't go to buy a car there? Everything else remains the same. The condition is everything else remains the same. Why? The reason being that for 10,000 rupees, 1,000 rupees is a big sum. For 10 lakh rupee, 1,000 looks very meager, small. This is how our mind reads it. This is how the question is framed. This is how we were asked. That's why we answer like this. Instead of where did we do our mistake? Instead of anchoring our mind to how much I save, we anchor our mind to the price. For 10,000, 1,000 rupees is big. For 10 lakh, 1,000 rupees is small. What is more important is that both 1,000 rupees is important to me. 1,000 rupees is the same purchase power, purchasing everything. I'm not saying that you should go and buy a car there. When you're going to buy a television there, you go to buy a car also there. When you're going to buy a car here, buy the television also here. That's what, because 1,000 rupees is the same thing. This happens in markets also. Okay. Okay. Now, this is an interesting case study. I have a separate PPT on power mutual funds, which may not have time. I want to take the questions as I said. So with this one or two slides, I'll conclude. When you look at World War II in Germany, many planes were shot, and they deployed a data analyst to establish a pattern, how it happens. Whether the most damages are seen on wings or the body or tail. And when they looked at the picture, this is how the picture looked. Okay, they employed Hungarian Jewish statistician. His name is Abraham Wall. And they came to a conclusion that initially that Most of the planes are short in the wings and the body and tail, so we have to strengthen that. Whereas this Hungarian Jewish statistician said that, no, you are wrong. You are analyzing the planes which have come back. Now, the planes which have not come back were attacked in the front part. Okay, they were attacked in the cockpit and and the engine. That's why they failed to come back. So actually, the wings are strong, the tails are strong, the main body is strong. What is weak is the cockpit and engine. That's why they are not able to come back. Now, this is what we call as survivorship bias. So I think read about this again, and I'll conclude with this final slide. This is how the psychology of market cycle looks. Initially when the market crashes, there is a disbelief, and then when it starts going up, there is a hope, but we don't enter. And then when it still goes up, then optimism sets in, but we try to look at confirmation from others. And at some stage we enter, and we believe it, we trust it, and we enter. And the market goes up, we are thrilled. And then there is euphoria, we don't sell it. The market comes down, we think it's only a correction, and it goes up. So we are proved right. Okay, it has come down, it has gone up. It's only a correction. So complacency sets in. I'm not going to do anything because it came down and it has gone up. It will go up. Even if it falls, it will go up. So I'm not going to do anything. Complacency sets in. But then this time the market falls more than the previous fall. There is an anxiety. You're thinking whether to average out or sell and get out. Then market falls further. There is a denial. No, I think there is something terribly wrong. It will recover. And then it doesn't recover. The panic sets in. And finally you sell at the bottom, what we picked up at the peak. And invariably, this is what happens. And I show them, remember the palm. We always don't believe here, and we start believing here, and we start entering here. And when it happens, it comes down. We think that it is a correction and wait. And when further correction, we try to average, whereas again we come. So this is always remember that. And which is not a political symbol, but remember that. So develop a system which facilitates, have a mentor, one among yourself, organize a study circle. CPE like this can also be, informally on a thing. CS study circle is active in Chennai. I don't know about Hyderabad. So we discuss a lot and keep learning, read, watch, browse, or read. I think one thing in our profession is that we keep writing exams, we keep writing, attending CPEs, and that is something which keeps all of us alive. I, for one, keep attending the CPEs, and I write a lot of the certification exams on derivatives and all to keep ourselves updated. Otherwise, we cannot be in our business. That's a forced thing, in fact. And very, very importantly, learn to filter the noise. Too much of information is coming. What is right? What is wrong? We should not shut our ears sometimes, or setting more than shutting. Don't listen to it and filter it. How to filter it? It's a separate art. And is what Howard Marks says. The desire for more, the fear of missing out or FOMO, the tendency to compare against others, benchmarking at a different level, raising the bar, the influence of the crowd and the herd mindset, the dream of the sure thing. Sure, I have really made this money. Sure, it is bound to go up from 5 rupees to 50 rupees. These factors are universal, nothing unique to India or any other market. Thus, they have a profound collective impact on most investors in most markets. And this is especially true at market extremes like this. And the result is mistakes, frequent mistakes, widespread mistakes, recurring mistakes, and expensive mistakes. And let's not do that. And asset allocation during such volatile times helps us to correct ourselves. In short, this is what asset allocation does. Napkin Finance is an interesting website or Instagram. This thing you can look at it. Everything explained in a single napkin. All the financial concepts. And I mean, they've done it. I've taken it from them. The credit goes to them for explaining it in such a simple. This one slide would have saved us 1.5 hours time. This is what it does. And yeah, I would request, I have a special request to make all of you before I answer this. The financial freedom is something in the concept of FIRE, F-I-R-E, financial independence and retire early. The concept has taken off in a big way in Western countries and come to India also. And as people in the world of finance and I think we all have a responsibility to play this. The main reason for me to accept these kind of events is that instead of reaching out to 5,000 client investors, by reaching out to 50 or 60 chartered accountants, I can reach out to 50,000 clients. That's the one reason why I try to address this on a on a holiday, on a Saturday, I have taken 1.5 hours, 2 hours time. Giving money is easy, but giving knowledge or giving, sharing knowledge is something very important. That to another set of knowledgeable people who can take it to several thousand people, so that we can make India as a strong country. Because I get pretty upset when the India's largest private bank is owned by foreigners. 75% of the India's largest private sector bank is owned by FIIs. Because why? They know that every Indian is a honest Indian. They all work hard, study well, get a job, and they borrow a home loan and repay the EMI. They borrow personal loan, repay EMI. They borrow education loan, repay EMI. They borrow all sorts of vehicle loan and repay EMI. And let's make money out of it. In our community, we say that, when I was young, my father told me, first thing to learn is calculate compound interest. Basically bankers, we are all. So he said, those who don't, learn to understand, calculate compound interest, get it, and those who don't know, pay it. So that's a simple thing. Let's all spread knowledge. In our charitable trust, we don't accept any donation, or we don't give any donation. And we take, whatever honorarium I get goes to this, and whatever money, my personal money, I invest in it, and we pay a resource person. And we only provide resource persons to conduct these kind of programs for government schools and colleges, using the SEBI's material, which is given by the SEBI for the resource person, which is given free of cost by SEBI. We take care of the resource person cost. We don't accept donation, we don't give donation, but we share knowledge. We also welcome any one of you to volunteer and share knowledge. With this appeal, I conclude. Let me go to the question answer.
Should I read out, sir? You will take up.
I can take it up, sir. It's there on this thing. Okay. Margin of safety coupled with return on investment. That's a very interesting question. I don't want to go too much technical into it, but in simple terms, what I can tell you is that about a year back, or 1.5 years back, when when the COVID lockdown was announced, I started investing heavily, because 2 months prior to that, in January, when I looked at the index, the PE was quite high, closer to 30. Nifty PE was closer to 30. I was not very comfortable at that, because reversal to mean has to happen, and it can come down, if not to 18, the regular mean, but it can come down to 22, 23. So I sold. So I was in liquidity. When March 23rd, I remember clearly, when the lockdown was announced, next 1 week I invested in the companies like State Bank India at 150, 60 rupees. ITC at 150, 60. I mean, dream run. A company like EAD Parry at 105, 110. Ramco Industries 105, 100. Good management, good corporate governance. And these companies are available at throwaway price. I'm not recommending any of these shares, but I'm just telling you what I did. Basically, because I was earlier in liquid, using my asset allocation model, I sold and had liquidity in January, which I was not able to deploy for 2 months. I deployed in March and April. But after that, I didn't know what to do, because market was continuously going up beyond my logic, because we are thinking that lockdown and the economic slowdown and the market was going. I kept. But in September, October onwards, somewhere down the line, I started booking profits, which is a mistake. When I say that these 1-year-old, 1.5 years old youngsters might make mistakes, but one advantage is they come out with fresh ideas. Whereas 30 years experience of mine was a hindrance for me. It is a drawback for me, because I have seen so many failures in the past that I got out of the market much earlier than this thing. So I don't know what to do. So then because I was I invested in IT sector 2 years back, I invested in pharma 2 years back. So I started getting out of all these things when the market went up. So I was in liquid. What I started doing, in fact, I have tweeted in my Twitter handle, it is there last year, November, during Diwali. I said, I am looking at a great value in CPSE ETF and some of the public sector companies. Why? Not because they will go up, multiply, they will become multi-baggers or anything, but I look at them with a high margin of safety. That's what you have mentioned. Highest margin of safety, because many of them are zero debt companies. Many of them have huge cash flows. Many of them pay dividend, huge dividend. Last year, I think IOC paid close to 20 rupees as a dividend, including the interim dividend, and trading at 80 rupees last year. So which other company can give you such a high dividend and trading at this thing? And many of them are, this thing. So that's how I look at the market, and it is always better to look at high margin of safety and enter than entering the market due to FOMO. Okay, that's my answer to that. And one question is, out of gold and gold bonds, which can be preferred? I think I explained it. I would rather prefer as an investment sovereign gold bond. And as an ornament, it's a different purpose. I'm buying a nice shirt and wearing, or I'm going to a theater and watching a movie, or I'm going for a travel abroad. I'm buying gold jewelry. It's an expense. Write it off. Don't call yourself, and don't call myself, and I'm fool myself that it is an investment. Indian housewives will never ever sell gold because the gold price has gone up. I think many places I have developed a lot of enemies because I'm talking about this subject. Okay. Can you suggest any strategy for retired persons to get monthly fixed return like pension by investing in one time in stocks or mutual funds? Maybe I think I was, in the lighter vein, I was telling someone of your, this question that invest in ITC. Because it's like fixed deposit giving 20 rupees, 10 rupees or 11 rupees dividend and all. But I would not suggest you that. I'm not supposed to talk about individual stocks or anything in this program. But as a strategy, what I can suggest is that we normally suggest 3 buckets strategy. The first bucket is a regular income scheme where you invest in SCSS, Senior Citizen Savings Scheme, and Prime Minister's Vaya Vandana Yojana. Both of them give 7% plus return for a period of, I think this one is about 10-year period, I think. And you can invest in that. And your wife is a senior citizen, she can also invest in one of those schemes, and which will give you a good rate of return, which will take care of your day-to-day expense. This is the first basket. The second basket is emergency basket. In case of emergency, you want to take out some money, put it in liquid funds. And the third basket is a capital growth or wealth creation basket, because if you are retiring at the age of 60 and you want 10 to 50,000 rupees a month, and you have invested in your first basket, which gives you 50,000, right? At the age of 70, this 50,000 is not enough for you because of increasing cost of living, because of reduced rate of return, interest rates are coming down, and more because of new needs. Somebody at my age know that 30 years back, we never thought of having a air conditioner at home. A typical middle class will never think of having a second television at home or washing machine at home. Even to buy a wet grinder, they used to think twice. That was the kind of the automation in middle class houses, or 30 years or 40 years back. Today, every middle class has got 2 televisions, a washing machine, 2 vehicles, 4 phones. We used to wait for 1 phone. We used to wait for 1 scooter waitlisted. Now we have so many vehicles and so many phones and all. So new needs keep coming. Last year, we never thought that every household has to buy a hand sanitizer and a mask. Today, we have to provide for in our budget. So what I am trying to say is that if you divide your savings into 3, first basket is for income. Second basket is for emergency. Third basket is for wealth creation. That you put it into long-term quality equity, Nifty stocks, or index stocks, or a balanced advantage fund, which will keep appreciating. Don't touch that. At the age of 70, take that money and put it into fixed return, which will give you the incremental return, 50,000 plus 10,000 or 20,000, which you, because of the lower rate of return, which you need because of. This is how. Always remember this 3 basket formula. You can see a lot of articles on the net also. Okay. Next one is refer to the flow of IPOs. We do not observe any strict regulatory tracking on utilization of funds raised as per the declarations made in RHP. So that's a news to me. I've heard about 1 or 2 instances, but not completely. The corporate governance is very poor. It goes without saying. It not only in that case, most of the cases you can see that one of the biggest group, largest group in India, when you look at it, is the share price never went up for the last 20-25 years except one company. And there was a family feud or a problem in that company, and the new person who came in was sent out. Then after that, you notice in the last 4 years, all the stocks have started going up. I don't want to mention the group. In fact, that group is known for excellent corporate governance, and we all trust that group for many things. That brand will buy anything. But then they themselves, from the market point of view, that's how it happened. I don't know whether it is by design or whatever it is. We don't know. But they are a good group, so it's too difficult to wrongly judge them also. So, but the fact of the matter is 20 years it never went up. None of the stocks went up. Last 5 years, most of the stocks have gone up. So governance is an issue. As far as IPO is concerned, I'm not happy with the kind of the valuations the market is giving. But of course, people talk about modern theories like OPEX versus CAPEX. Earlier we used to think of the companies who are coming out of the CAPEX a cement company investing 5,000 crores into machinery, plant, land, a tangible asset. Today, these companies which are coming out, high fintech companies which are coming out with OPEX, where they invest a lot into the talent pool and which is written off in as a P&L account item, not as a balance sheet item. So it looks like a loss. For a period of time, it may not be loss. This is the theory being floated around. I don't know. We have to wait and see that whether it is true. But I'm not very comfortable going for such high valuations of companies. Instead, I don't mind, waiting in the sidelines and this thing. Regulatory part, I thought all along that they are doing their part, but I don't know if they have not done it in 1 or 2 cases. I know that the application of funds was not intended for that purpose. They have misused it, and I think their action has been taken. Maybe let us see how it goes. Mr. Sudhar Rao has asked, do you think the equity market is presently in a euphoric stage? Yeah, yes and no. I would say that in a way it is certainly euphoric stage when I look at the IPO, but it is not completely like it was about 6 months back. I would tell you why. A few months back, when the index was even 60,000 or 50,000, the PE ratio was at the age of 40 plus. Today, the PE ratio has come down below 30, 24 or 25. I am right. The last one NSE website says 23 or 24. Why? In spite of market going up, why the PE has come down? Because earnings have gone up. So that's the reason. So the markets or the economy is not as bad as we thought in 1.5 years back. And the job loss is not as bad as we thought. In fact, it has gone up, and the payment to IT sector has gone up. The disposable surplus is very high. So that's why it is like that. So market is euphoric in certain sectors, in certain areas, but at the same time, there are still some values post this last 1 month correction. I do see some values in certain sectors. For example, I still look at public sector, some of the public sector companies, but for the goof up done in IRFC, IRCTC, I still see some potential upward movement in public sector companies due to the valuation. Maybe infrastructure and cement. The problem with infrastructure is transparency and governance, but some sectors are expected to do well indirectly. I'm looking at those kind of stocks, and what it is. I think, have you answered all or?
Yes, sir, almost
yeah,
all completed.
Yeah.
Thank you, sir, for your wonderful presentation. Actually,
thank you, sir. Once again, thank you very much for the opportunity.
Yeah.
Would like to meet you all physically when things open up. I think I would be very happy to meet all of you. Thank
Definitely,
you.
Sir. We are also eager to meet you personally, and we will take your advices also. A lot of appreciation messages coming to you, sir. Really very glad to hear that one. Yeah, thank you very much, Nagapan sir, for your wonderful presentation. Sir, there is no doubt you have motivated all of us towards investment horizon by your ideas. We from Hyderabad branch sincerely thank you for your power-packed presentation. The way you have took up the session with live mode and answering QS question answers shows your grip on the subject and passion towards educating all of us. Sir, as a token of appreciation and gratitude, please accept our virtual certificate of as honor and appreciation towards your presentation, and thanking you for accepting to address us. Santosh, can you please present the certificate of appreciation? Sir, please accept this virtual certificate of appreciation, sir. We will send you this one in the physical mode very shortly. Thank you once again, sir. Members, for your information, Hyderabad branch along with Warangal and Karimnagar branches organizing a 2 days sub-regional conference on 29th and 30th December 2021. We have a lot of experienced speakers to address us on these 2 days, starting with CA Gurraj Acharya sir on income tax, CA Apurva on GST, CA Utpal Sen on transfer pricing, CA MP Vijay Kumar sir on new schedule 3, the Companies Act, CA Nayan Sabu on professional opportunities for members, and CA G Murali Krishna on FEMA. Requesting all of you to register for the same and to attend. Yeah, this is covering all our core areas of practice. Once again, sincerely thank you all the members.